Hey, Violeta, how are you?
Hi, Tracie. How are you? Thank you so much for being here. I don't know if you know, but I just started 2023 a podcast. And
Oh,
also,
that's great.
yes, and also I've got the YouTube channel going and everything. So this month, January, I am dedicating to home buyers.
Okay.
And so every week I'm coming with different content that I think is going to be valuable. So today I have you. So Tracie is my favorite lender. She's
Oh,
with
thank
a
you.
mortgage
Yes.
and she's very knowledgeable. She's licensed in most states in the United States. I recently actually used her to two transactions for my own daughter. So if I refer her to my family, that means I
Hey, that
trust
was
her
my
a lot.
test, right? I passed the
Yes.
test. So,
So yes, so today I wanted to bring her in. So we talk about 2023 financing options. As you know, the interest rates went up. Now they're a little down. So what's happening? So she's the expert and she's gonna tell us about it. So do you want to introduce yourself more
yeah,
than
yeah, just to give people a little bit of background. So, I've been doing mortgages for over 25 years, and I could help people. Usually, it's just to build wealth through real estate. And I've been through the market crashes. I've seen interest rates go up and down. I first sold mortgages at 16%, right? So 6%, 7% isn't anything that I haven't really experienced before in helping buyers still get into homes. And we'll talk about that a little bit. So we do residential lending, we do commercial lending. We can lend on land, we could do business loans, we could do investor loans. So we'll go through some of the products as well. And really for you, Violeta, I want you to be able to have, I wrote a book, I co-authored it with our real estate coach that we both work with, and it's called Making Mortgages Easy. And I could send you that link. So anybody through your podcast or your YouTube channel that wants to get a copy of it for free, they're welcome to do that. And it will take them through, the questions to ask you as their realtor, what to ask their mortgage lender, how to pick the lender, and really takes them through that process. So I would love to be able to have you give that as a value to the people that listen to your podcast. And
I would love that. And actually, I'm going to list all the links, how people they can contact you, a link to your book and everything in the show notes, in a podcast or wherever I'm going to repurpose, this video and audio to my platform. So people, I can reach more
yeah,
people.
and you're in Miami, right? And that's your focus,
Yes,
where
yes.
you're
I'm
working out.
licensed broker in Georgia and Florida, but my focus 2023, it's gonna be Miami, 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 because otherwise I've been back and forward transitioning from Atlanta to Miami, and obviously my business has been in Atlanta a lot since I've been doing that 20 plus years.
Yeah,
Yeah, so I've got a lot of referrals,
yeah,
but I'm just committing to
good.
Miami this year
Yeah.
and to help people over here
That's
with
great.
my
And you
knowledge.
mentioned, so yeah, I'm licensed. I physically live in California, but I'm licensed in the whole state of Florida, in the state of Georgia. I have about 6 or 7 personal licenses. And then with our company, we can work with loan officers within our company in pretty much every state across the country, except for just a few. So, like you were saying, people are moving from all different places to Miami, right? And they're kind of moving in and out of states, especially with the way the economy is in the market. So we want to just let people know we really could be a resource for anyone, right? And kind of put them in the right place with the realtor or lender, whether it's in Miami or Florida or Georgia or wherever they're looking and happen to find you. So,
Yes, totally. And
all right,
thank you
let's get
again.
at, like, I know you're going to drill me with some questions, some lending questions. So let's
Yes,
get
yes,
going.
yes. So first of all, I advise all of my current or future clients before they start the home buying process to connect with a loan officer who can educate them about numbers so they
Yeah.
know their numbers well before they start actually the house hunting.
Mhm.
So what would you say, how long time does it take, what's the process, what
Sure.
documents they need to provide you for you to actually come with these numbers and give them
Yeah.
clear picture of
Yeah.
what to
So
expect?
I work differently than a lot of mortgage lenders because I feel like getting as much information as they can up front and helping you understand, or your buyer understand, their buying power is so important, because a lot of times mortgage lenders will just take an application over the phone or get some general information, not even review credit or know what debt someone has. And then you take them out shopping as the real estate agent and they find the home that they love, and then all of a sudden find out they don't qualify. So I don't like to do that. I like to get as much up front, so when you find the house you love, we can close super quick. I mean, close in 10 days and 12 days, so you could be more competitive in the market. So when someone is self-employed, there's a little bit more documentation that they would need to have, like their tax returns. But if you're talking about someone that gets a W-2 and a pay stub, it's really easy. They'll fill out an online application that's secure, and it notifies me when they're done, and it will just ask them for their personal information that they want to make sure they're getting over to a mortgage lender securely. And then they'll be able to also upload their documents, like their 2 most recent pay stubs, 2 years W-2s. And then I only ask for 1 asset statement from whatever account they're going to use for the down payment. So 401k, checking, savings, anything like that, investment accounts. So I can really understand, do they have large deposits? Do they have to move money around? All of those things are important before you submit the loan into underwriting when they find a home. So from the time I get that documentation, it really only takes me about 2 or 3 hours, that same day, depending on the time, to work up numbers, figure out interest rates, down payment options, loan programs, run automated underwriting. And then I'll send a spreadsheet to the buyer saying, here's the maximum comfort level based on the payment you told me. And then here's some sales prices in a range, so you can determine what letter you want me to send to Violeta as your real estate agent, right? This is the home range that you want to look in, because this is what you're comfortable with as far as payment and money that you need to close your loan. Okay. So it's an easy process. It really is. People think it takes hours and days and weeks and months. You can't in this market. You have to be really quick, especially if you're ready to buy.
Yes, exactly. And also, a lot of people think they need a large money of down payment, when in reality, they can even buy a home with 0 down payment. Is that correct?
Yeah. So the 0 down payment is really meant for people that are active or retired military with the VA loan. There are down payment assistance programs that allow for, it's an FHA loan, which requires usually 3.5% down payment. So there are down payment assistance loans that you can get up to 3.5% that will cover that down payment option, but you still need to have closing costs. And that's what I try to educate people on. There isn't a true 0 money out of pocket loan. You can get credits from the seller, which we know, which will help with closing costs, depending on your market, right? Because sometimes you can get a credit from a seller and sometimes you can't, depending on the home itself. So yeah, but if you're a first-time home buyer, you could go as little as 3% down on a conventional loan, or 3.5% down, 5% down. You don't need 20% down to buy a house. That's a myth.
Yes. And also, how much are the closing costs approximately? Is it like 3% I'm quoting them of the purchase price?
I usually average about 2%. In Florida, it's a little bit different, because your state has a little bit different like taxes and things that are required that like a state like California doesn't have. So usually I say like about 2%, but in that worksheet that I send, I'll break down an estimate just based on my experience in each state. So the buyer will always know total cash to close is the term that I use. So you need down payment and closing costs, and this is the total amount that you have to be prepared to come to closing with, and give them that number up front, so there's no surprises later on in the process.
Exactly. And that's critical, because once you go into the contract, you've got, time is of essence. And if you're not approved, pre-approved, if you just went online and, just got this online pre-qualification letter from someone over there, and then you go into contract thinking that everything will be fine, I promise you it's not gonna be fine. And then you might lose your earnest money deposit, which runs about 1% of the purchase price. It's not, you can lose the money for the appraisal, you can lose the money for the home inspection. So in the event you don't go to the closing table. So
Yeah.
that's why the first thing you need to talk to someone who's actually is referred by your realtor, so they know what they're doing to make sure that you actually go to closing.
Yeah, and a lot of times people, especially, I mean, the price points in Miami, what's your average sales price there now?
The average sales price in the area, I'm in Brickell, which is the business district, is about 850,000.
Okay, so with that price point, you're still talking about, non-jumbo loans, but sometimes people, that are buying homes that are business owners or that have a decent amount of money, they just want to know, what's my rate and payment? So, and I always tell people, it doesn't matter what the rate is if you don't qualify. It doesn't matter what the payment is if you don't qualify. So I understand rate's important, right? But let's make sure first that you qualify, your debt to income ratio is good, you don't have anything on your credit, you don't have large deposits that we can't source. Let's make sure all of those things are buttoned up so I can get you the best possible interest rate with closing your loan with the best possible, investor on the back end of that loan. So, because a lot of people don't want to provide the info, but it's, I say to you, like, you're looking to borrow $700,000 from a company, but you don't want to provide the documentation to show that you qualify to borrow that money. And when you think about it, it's like, okay, wait, that just doesn't, you're not going to go to a doctor and not look at his references, right? It's the same thing. Like, you need that foundation of information to go out there and shop for a home. It's so important.
Right. So can you talk a little bit about the difference between owner-occupant and investment loans? Like, I know the investment loans, they require more down payment. Also, if we can talk a little bit about self-employed people, because I've got a lot of entrepreneurs that they write off a lot of their money. So I know that you have programs based on bank statements or something. They can still qualify even if they don't show that. Also condo, I know we've got a lot of high-rise condos here. So what will be the minimum down payment? If you can just kind of give us like a high level
overview. So with conventional financing, when you're buying something that's owner occupied, that's what I was saying. If you're a first time home buyer, you could do 3% up to the county loan limit, or 5% if you're not a first time home buyer. And that's considered like an owner occupied property. When an owner occupied means that you're going to take possession and live in the home within 60 days of closing on your contract. Then you have what's called a second home. So let's say, for example, I live in San Diego. I want to buy a home in Miami. It's going to be my second home that I'm going to live in for half of the year, let's say. It's going to be more than 50 miles away from my existing residence. And in that instance, you only need a 10% down payment. So it's not like an investment purchase. And then you have an investment purchase where your intention is you're going to buy the home and then rent it out. You're going to either do a short-term rental like a Verbo or an Airbnb, or you're going to rent it to a tenant and have that as an investment property. So those range different in down payments. Generally, you're going to need at least 20% down, and then you're going to need some additional reserves. When I say reserves, it means not money that you're going to bring to the closing table, but money that you'll have left over in an account, like a checking account or a savings account or a retirement account, to make sure that if your tenant doesn't pay you, you can still pay the mortgage, right? And it's usually for about up to 6 months that they want to see you having that in your bank account when you close the loan. So there's a program called, and I don't know if you've heard of it, it's out there everywhere, DSCR. And a DSCR loan is specifically for investors, and it stands for debt service coverage ratio. And really what that does, it allows us to qualify someone with no income, no debt to income ratio. All we do is we take what the projected rent of the investment property is going to be. And as long as that offsets what the new mortgage payment is going to be, that's how we qualify them to be able to buy that investment property. And you don't have to be a first-time investor. So a lot of people want to get into buying real estate, right? And so you don't have to have a history of renting. You really just have to have the money to be able to invest and put down in that particular loan type.
Wow, that's so cool.
Yeah, it's pretty cool. And you asked about so self-employed people, it is common that you have your gross income and then you write off your expenses and you have your net income. So people that do write off a lot and can't document their income on their taxes, you can do bank statement loans. You could provide 3 months of bank statements, 6 months, 12 months, 24 months. The larger number of months you provide, the better the interest rate you get, right? Because you're documenting more history of income. We have what's called a no income, no ratio loan, which you don't have to show any income. There's no debt to income ratio, no taxes. That's 20% down. And again, on these particular products, you're going to have higher than market interest rates because they're risky. You're buying a house and not showing any income that you can.
But there is a possibility you can still get in a house, and
it gets you into a house. I mean, especially someone maybe that's been self-employed for 2 years, but the first year was tough because you're just starting out. The second year was better, but you're writing everything off still. And so if you have that money to put down, that's the best program to get into to save for, just a few years, and you could always refinance out of it, if that's something that you needed to do.
And do you have on the top of your head what will be the interest rate compared to the, let's say if today's rate is 6%, is this kind of loan like 2%
it's usually about
above?
I would say on average about 2.5% higher. Like I just priced out a bank statement loan for a borrower, and it was a purchase, and the rate would be 8.375, where let's say if they could document their income and not use bank statements as self-employed, they'd probably get closer now to like 6.75, right? So you're going to probably be maybe up to 1.5 to 2% higher.
Okay, perfect.
In rate. Yeah, so it's not really high, but it's going to be higher because it's called a non-QM loan or non-qualified mortgage. So, those are mortgages that don't follow the traditional guidelines.
And I'm so glad I invited you because some of these products, this is the first time I'm hearing about, and I'm not sure if your recent move to this Nexa mortgage is something that they have additional loan products.
Yeah. So, well, the cool thing, so with Nexa Mortgage, and the reason why I made the move is we have access to over 190 different lenders so I'm a mortgage lender, but now I have like lender companies that I can work with depending on the situation. So, we have the ITIN program. If you're part of DACA, if you are doing bank statements, reverse mortgages, equity lines of credit. So that's why I made the move, because you want to be able to try and provide a solution for everyone that's looking to build wealth through real estate. And when you work for a retail mortgage company, you're limited a lot of times to the products that you can offer. But at Nexa, there's land, 8 units, high rises, like you were saying, there's endless amounts of products that could help people.
Yes, I see. And also you now you mentioned all of these different, programs for different people. I know that there is also special programs for teachers, special programs for medical workers, special programs for police and firefighters and stuff like that, right?
Yeah, so it's like a first responder type of program, or someone that is a teacher. It's a down payment assistance program. The thing that you have to be careful of is there's guidelines for down payment assistance like any loan program, right? But a lot of times in the higher end markets, like in San Diego or in Miami, where our price points are a little bit higher than maybe the rest of the country, there's also costs to get that program that you have to build into the loan. So what I try to do is look at, would you have a better interest rate if you did an FHA loan but got a credit within the interest rate, or if you got an FHA loan with down payment assistance? And that's why you have to have a lender that's educated and can break down options, because a lot of times the down payment assistance, you can get the same amount of assistance on just a traditional FHA loan at a better interest rate. So that's why you need to know that stuff. And, as a real estate agent too, it's so important to know, if you have a buyer that is like kind of afraid of current market rates because they're higher, and it has going to increase their payment, there's what's called a 3-2-1 buy down loan. I don't know. Have you heard of that, or do you know?
Yes, I've heard. And actually that's on my list to talk about with you, because you know, a lot of buyers, they got scared because the interest rates went up, which these interest rates, actually, they're, you know, it's a good interest rate, 7%, 6%.
Yep.
What we've seen, that was just not normal. It was abnormal what we've seen, like 2-3%. But
Exactly.
people, they got used to that, and now they're, you know, they're like scared. But I know you've got this 3-2-1 buy down, you've got RM loans, like 5 years, 7 years. So
Yeah.
you know,
I want to, so
rates
let me,
go down.
I'm going to share my screen really quick.
Yes,
So,
please.
so there's what's called a buy down calculator. And so the way a 3-2-1 buy down program works is the buyer locks in the interest rate at current market. Okay. And then for the first year of the mortgage, their payment actually is reduced by a lower interest rate of 3%. So whatever the current market rate is, their first year, the rate will be 3% lower. The second year, it will be 2% lower. And then the third year, it would be 1% lower. So it goes 3, 2, 1. Okay. At the end of the third year, it goes back to what we locked it in at today at current market. Okay. So ideally, the goal is within the next 3 years, you'd be able to refinance out of that loan, take advantage of the lower rates with this program, and then lock into, you know, a longer term loan after the 3 years or within that 3 years. The way that this program is funded is we have to have the seller of the home that you want to buy provide what's called a seller concession or a seller credit. And it has to be funded by that credit. So the buyer isn't going to pay this themselves, right? The seller will pay it. So I'm going to show you how that works. So we're going to say, okay, average purchase price, we're going to just use is $850. We're going to do a loan amount of $765. We're going to say initial interest rate. I'm going to use 6.625%. Because right now, if they buy it down, you could get a rate of that. So rates have definitely dipped below 7%, which is great, especially if you have good credit. So we're going to just give an example that the monthly payment on that scenario would be $48.98. And that's considered just principal and interest. Okay. Now, again, if I change the loan amount and I put the loan amount at $760,000, you know, I could show a borrower what that would do to the payment. Okay. So we're going to look, there's a 1-0 buy down, a 1-1. I'm going to go to the 3-2-1 just to show an example. So you could see here in year 1, your interest rate would actually be 3.625%. Okay. And it's going to tell you what your new payment would be based on a rate 3% lower. So look at that. It saves $1,400 a month that first year for the buyer. Wow. Okay. Are you following along with me so far?
Yes.
Okay. Year 2, the rate is 2% lower. So 4.625. The new payment would be $958 lower. Okay. And then if we have year 3, it would be 5.625 and the payment is about $491 lower. So what has to happen in this instance is you could see the annual savings, okay, totals $34,207, which is a 4% of the sales price. So you would need 4% concession from the seller or a credit for $34,000 in order for the buyer to take advantage of this type of loan. Okay. Now, sometimes people are like, that's so much, but you have to understand with the market shift, sellers are reducing their prices now. So what we say is, hey, instead of reducing your sales price, instead give the buyer a credit. Because then look, they could take advantage of something like this and they could save money in their payments and you'll sell your home a lot faster as a seller in that instance.
And then 4%, let's say, can they still have the seller give concession against their closing cost up to 3%, or this will?
That's a good question. Yeah. So if you buy a home and you put down less than a 10% down payment, the maximum credit you can get from a seller is 3%.
Yes.
If you put 10% down or more on an owner-occupied purchase, you can get 6%. So in this instance, we would get 4% to buy the rate down And you could ask for another 2% to go towards the other closing costs. Yes.
Okay, so this is considering like percentage for the
total.
Either, yes, for both. And an FHA, I know it was up to 6% you can ask.
6% on FHA
can
and
you
4%
use that
on
program for FHA as well? So that works for any kind of loan, not just
it doesn't work
conventional.
for jumbo. It works for conventional, FHA, and VA. Just
And
non-jumbo.
VA.
Yep.
Oh, that's
So
good.
VA maximum is a 4% credit you can get from the seller always. FHA is 6%. And then you have to be careful because if you buy an investment property, it's a different percentage. So you just have to talk to your lender, right? If
Yes,
you're going to ask
exactly.
for a credit.
Yeah, and it's on case by case scenario. It depends. It's very, very specific to this person, to their credit, to what's their situation. That's why you can, based on where they are, you can tailor specifically to them what will work and what
well, that's why too it's having a realtor like you, Violeta, in your corner, where you can look at homes maybe that have been in the market a little bit longer, or maybe need some updating, or could talk to the listing agent and see if there's an ability to negotiate. And the 3-2-1 buy down you could see as a large percentage of credit needed, but there's a 2-1 buy down, which is still at lower interest rate year 1 and 2, a 1-year buy down, so lower interest rate year 1. So there's all different things that we could do to try and structure the loan to help the buyer afford the house.
And that's why I think our professions, even, the technology replaces a lot of realtors, because everybody can go and search online and make offers. But when it comes, there's so many things that you don't know as a consumer. And that's why it's good to have your own representation, because there are so many things that we can see ahead of time based on experience that can happen.
And it's important for for buyers to know, buyers don't pay us, right? Buyers don't pay you. Buyers don't pay me. So you're getting a team that ultimately the seller is paying for on your behalf, and my company pays me, right? So that, exactly. I mean, I think that for a buyer these days to just go online and Google, the lowest interest rate, you might be missing out on concessions or different products, and interest rate again is important, right? We have really, really competitive rates, with Nexa Mortgage. So that's why I say always talk to at least 2 lenders to compare. Right? Even if your sister's a lender, still compare it, because what if you get a percent lower in rate?
Yeah, you need someone who knows what they're doing. And interest rate is not the only factor, because they can tell you, okay, that's the interest rates, but actually they're hitting you on closing costs because they're charging you discount points to lower the interest rates. So you got to see the whole picture, because the interest rates, they can give you 5%, but the closing cost will be like 4% of the purchase price, which So,
I always tell people, I mean, I always do an analysis and show them, this is the rate with no points, this is the rate with points, this is the difference in payment, and then this is how long it would take you to recoup that money that you'd pay in points that doesn't go to your equity, and let them decide. To me, it doesn't matter, right? You could pay whatever amount of points you want or not want to pay. So I just try to give kind of those options to buyers so they can make an educated decision on what's best for them.
Yes. And what would you say if someone was on the market to buy, now the interests are going up? What I'm saying, the advantage is there are no multiple offer wars, right now. Also, when everybody was bidding on properties, you're paying, let's say 40, 50K over asking price. Now you can get the same property at, higher interest rates, but you can get it a little bit even under the asking price.
Absolutely.
The price is so pretty much I think it's actually win-win. It's win for the buyers right now. So I don't think in long term, if you keep the property at least 5 years, you can either refinance, you still build equity, even not, appreciation is not that much. So
that's the advantage. I mean, their houses are still, so when you buy a home, your house is still going to appreciate in value. And then you're going to be making a mortgage payment that's going to be paying down your balance. So you're going to be making money with a lower payment, like a lower balance, and with appreciation, right? When you're renting, you're paying 100% of your landlord's mortgage, right? So you're not investing your money into anything for yourself, and nothing is appreciating.
Yes.
So, I tell people, you probably on average will stay in your home, let's say 5 years. But if you buy a house today, and if the payment is higher than what it was going to be a year ago when rates were at a historic low, which it'll never be in the 2% range again. I mean, that's what everybody is saying, right? All of the experts, that was because of a pandemic, right? A situation that hopefully never happens again. But if you bought a house today and the rate was 6.625% and rates dropped down to 4.875%, usually there's no prepayment penalty on a mortgage loan. So you might be making a year or two of higher payments than what you would have made a year ago, but you're still earning appreciation over the next 2 years. You're still paying down your balance, and then you can refinance into a better rate. And the cool thing is, you don't even have to, like, we have loan programs that instead of going back to 30 years, you could do 29 years or 28 years or 27 years. You don't have to stretch it back out to the original term to lose all of that money that you've paid down. So again, it's always, a good time to buy. And I'll share my screen again, because I wanted to show you really quick, something where it's like, let me grab the document here. Okay. So it's like to buy or not to buy, right? So what should people do? And this is always the question. So we're going to give just an assumption of a tax rate, an estimated appreciation of a home, 3.5%. I think in our markets, like in Miami and San Diego, it's probably a little bit higher, right? We're going to assume a purchase price of a home. I mean, I'll use 850 just because we've been using that number. The down payment, I'm going to use 10% down, right? Because then you can get that maximum concession. Estimated closing costs, we'll use 2%, like what we've talked about. And what do you think if someone was renting a home that was worth $850,000, Violeta, in Miami? What are they paying in rent? Do you have any idea?
Yes, I have an idea. They're paying close to 5K.
5K. Okay. So let's put the monthly rent to 5,000.
Even more, depending, but pretty much in my area, you cannot find anything.
Okay. So let's use just 5,000. So their annual rent would be 60,000. We're going to assume that they'll have renter's insurance, right? And so this is their monthly cost of renting. So their rent plus a little bit of mortgage insurance, of homeowner's insurance. So their mortgage loan amount, let's say, would be 765, right? We're taking 850 minus 85,000. Let's just call the interest rate 6.625%. 30 years. Their principal and interest payment would be 4898. Okay. Their annual mortgage payment, you're going to see 58,781. You're going to have your property taxes. Now in Florida, is it an average of about 1% annually for property taxes?
Yes, if you are owner occupant, actually it's 1.5 in the county where I am right now.
Okay. So let me just do, so we have accurate information. So if I take 850,000 times 1.5%, that's going to be 12,750. So that's going to be our annual taxes. We'll assume about $100 a month for insurance. And because you're putting only 10% down, you'll have mortgage insurance as well, right? Which will vary. So let me just, usually this will be about $780. This is assuming no HOA, but again, if you have a condo, we have to add that in there. Okay. And then we're assuming annual home maintenance, right? So if I take $8,500 divided by 12, we're assuming you'll spend about $700 a month in maintenance of your home. Okay. It could probably be a lot less than that, but that's what we're going to say. So here's your total annual cost of buying. Here's your appreciation, right? And the value of your home that we talked about that you're going to get. And then you're also going to get a reduction in the principal amount of your mortgage, right? By keeping your mortgage over a few years of a term. Okay. So if you look, when you go to file your taxes, if you file your taxes and you itemize your expenses, right? You have tax savings on your property tax savings on your mortgage insurance, right? So this is your after-tax deductions. If you don't itemize, you're looking at a different amount, correct? But so what I wanted to show people is right here, the net annual cost of renting would be $60,215. Net annual cost of buying after the tax deduction, the appreciation, and the balance of your mortgage going down would be $37,818. So you're actually paying about $22,000 more by renting.
Yes.
Okay. So, and then if you take a standard deduction, it's less. It's only about 16,000 more. So again, now you still have to be able to afford the payment, but you are, right? I mean, $5,000 for rent. And the mortgage payment we said was going to be, where was the payment there on this scenario here? $48.98. Right now, you're going to have taxes and insurance in your payment, but you can also exclude those if you wanted to. So if you wanted to pay them yourself, you're able to do that as well. So I just wanted to tell people there's worksheets that things that we could do based on their situation, you know, to make sure it makes sense. If it's a lower sales price, maybe and it's a condo, but it has an HOA, we would want to look at it that way and see if it makes sense. So just to know that there's information out there for people.
So we covered so many things. I really appreciate your time. Is there anything else you want to add before I let you go?
Man, so for buyers, I would just tell people if they, okay, you don't have to buy tomorrow, right? But if they're thinking about it, and we kind of say like, if you're ready, let's go. But if you are, you know, within 90 days, let's talk about a plan, right? Because credit reports are good for that amount of time. If you're over 90 days from buying, let's not review your credit right away. But I could do what's called a soft credit pull, where it doesn't hit an inquiry on your credit report. It doesn't cost you anything, but I could prepare you of what you may need to do with your credit when you're ready to buy, right? So it's a soft credit pull that I could do. If you're a year out, that's when you really want to work with Violeta, get up on market updates, right? Get part of her newsletter. You want to get the book, like just things that you could do to prepare yourself so you could put a plan together of how much you would need to save each month in order to buy. So what I'm saying is it's always a good time for someone, even if they're thinking about buying, to talk to you and I, so we could put that map of homeownership together for them. So they're not just like out there and then all of a sudden they decide they want to buy a house and they call and they're like, well, you know, I want my payment to be $2,000 a month. Well, that's not realistic. Right? So know the reality of it now so you can prepare yourself for when you're really ready. So that's really the only thing.
Yes. And also one more thing I forgot to ask you that I've been, you know, dealing with lately is if the bridge loan or something else they can do if they wanna, if they have house to sell, but they wanna buy first and they don't want to make the buying conditional upon the sale of the property. I know there is a bridge loan or any other options that you can.
That's exactly, no, the bridge loan is pretty much what you would want to get because you have to have your house listed for sale, right? So they know you're going to sell it because it's generally a short-term loan. So it's usually up to about 12 months that you're able to have that money. Of course, houses are selling much faster in our market now. But so, and then what would happen is you would get money out that you would need based on the equity of the home that you own. And then the home that you're buying to use that money to put as a down payment without having to sell your home first. And that's good for people that have a fear of selling and not knowing where they're going to buy.
Yes.
Right. Because
and becoming homeless because they don't have a,
So usually what we do is if that's the case, if they're planning on selling, we'll pre-approve them, assuming a bridge loan, and then pre-approve them up to the sales price of the new home before they put their house on the market. So they understand that once they put their house on the market, if they don't want to write a contingent offer, they know what the terms are for the bridge loan and then for the new purchase loan, because we would have to do both of them. So the companies that do a bridge loan are going to also want to do the new first mortgage loan to make sure that you're going to qualify to afford both, because on the bridge loan, there's generally no payments due. Right? You're not making payments on that money you're borrowing on your current.
There's so many options. So the best thing is for people to just connect with you and I, and then start the process and see what's the best option in their situation.
Absolutely. And you can see, I mean, my information is there. That's my personal cell phone number. I always tell people to call or text. You know, if I'm not available at that moment, I have loan officers on my team that would, you know, be able to get back to you quickly on my behalf until I'm available.
Yes.
We like to have calls like this with buyers or consultations and really understand what they're looking for. And then, yeah, we just go from there.
Yes,
So.
totally. And I'm going to put everything, you know, your website, link to your book, your information for anyone who listens to that. It doesn't matter if they listen now or in 1 year or 2 years, you know, as soon as I run these platforms, it's going to be out there.
Yeah,
so
absolutely.
they know
Great.
how to contact you. And I really appreciate your time and you know, allowing me to introduce you to my audience. And yes, thank you so much.
No, I love it. I love educating people. It's what I do day in and day out in this business. So I really appreciate you taking the time, and until next time.
Yes.
Okay, talk to you soon. Bye.